The U.S. economy, as we noted, grew at a faster pace than expected in the second quarter, adding to signs the threat of a recession has faded, at least in the near term. This coming on top of what Jerome Powell said on Wednesday. The central bank staff no longer forecasts a U.S. recession. Joining us now is David Wagner, Aptus Capital Advisors portfolio manager. David, what's your read on where the consumer is when you consider what we've heard from some of these earnings calls and then what we got from the Fed yesterday?
Yeah, Akiko, you're exactly right. You're seeing it on the macro side, but also the fundamental side. You know, just looking at a lot of the stocks you just mentioned right there. But let's look at some of the macro data. And one thing I'm really focusing on is the U.S. household net wealth. All right. I have a saying that I always tell people that the market in the short term tends to focus on the rate of change. But over longer periods of time, it tends to focus on the absolute value. And if you look at the 12-month rolling year-over-year U.S. household net wealth, it's actually gone into negative territory. And whenever that has happened, it's actually coincided with some type of recession. But if you look at the absolute level, what I would say the market focuses on over longer periods of time, the U.S. consumer remains very, very strong. If you look at the net wealth, relative to, say, pre-COVID, they're about 34% more wealthier than where they were Q1 2020. If you look over on a longer period of time, relative to maybe the last 10 years, the U.S. consumer is 120% more wealthy than where they were. So right now, the consumer remains very strong. Their propensity to spend is still there, and it's definitely not stopping this economy right now.
So, David, what does that tell us just then about the odds of a recession down the line? If, in fact, the Fed is not done hiking, if we do see another raise here before year end, where does that stand just in terms of the likelihood of a downturn and how extensive that could be?
Well, the can has definitely been kicked down the road. If you looked at, majority of the economists entering into this year, almost 95% of them said that the U.S. economy was going to go into a recession in 2023. They actually just redid that statistic just last week. And now only 58% of people actually see the U.S. heading into some type of recession. So it's definitely the consumer that's, definitely guiding this market through this type of scenario. And at Aptus, one thing I think we do well is we write very thematic papers. And one thing I was going to write on the consumers, it's going back to Ayn Rand's book, Atlas Shrugged, came out like 1960. But in a way, right now, the consumer is Atlas, holding up the world right now because obviously GDP numbers came out this morning. The consumer accounts for now 72% of GDP. So they continue to carry this market forward. And you know what? A lot of investors right now are waiting to see if Atlas, i.e. the consumer, if they're going to shrug.
There's the question of whether another rate hike can be coming, but also the question of how long we remain at these levels in terms of interest rates in order to make sure that inflation doesn't re-accelerate. How do you view that right now? Are you already looking at the potential for maybe a cut at the end of the year next year, or you think we're kind of at this level for a while?
Well, there's definitely a difference in what the Fed has been saying 6 weeks ago and then again yesterday relative to what the market is really saying. I mean, the market's saying that, hey, you know what? We don't believe any more rate hikes this year. In fact, we think some type of rate cut next year. Obviously, the Fed, Jerome Powell, is saying something very different. I think what the Fed has done really well lately is a consistency and transparency of their messaging to the market right now on what they're going to be doing. It's unfortunate the market doesn't believe that, but the number one thing that Jerome Powell doesn't want to do right now is go back to what happened back in the 1970s. Go back to that stop and go mentality from a monetary policy standpoint. And that's what we're actually seeing across the entire globe right now, that a lot of these different countries are actually having to go back to raising rates to fight inflation because it's really sparked back.
And the other obvious data points that we've been getting over the last several weeks has been earnings. We're starting to getting a look at some of the tech giants here this week. Meta was the latest to report last night, better than expected results on both the top and bottom line. Also, their guidance was very strong. From the earnings results that we've gotten across the board so far, the beats have been very strong. Over 80% of the companies have beat the street's expectations. Is that enough for the market to keep that momentum to the upside?
Well, it's like the market's trying to take the playbook of what's happened the last 5 quarters. Obviously, earnings per share, EPS, has been very insulated, especially since February. Every single sector in the S&P 500 since February has seen an increase in EPS right now. And what we know is that the market tends to follow that statistic very closely. As earnings per share revisions go higher, really so does the market right now. But one thing I'm really focusing on, because, Seana, I really agree with you. Yeah, 80% of the companies have beat on the top line, like 64% of the companies have beaten on the bottom line. But look at the market's reaction to those beats, right? Because the average beat on a quarterly basis is like 73%. You mentioned 80%. Well, the following day, the performance of those securities reporting the following day, on average, they're down about 25 basis points, when historically they are about beating the market by, say, 1.5%. So from a sentiment perspective, what is that telling me? It's, telling me maybe all this good information, all this guidance talk, all this management commentary that we're seeing is already priced into this market at a 20.5 times forward earnings.
Or maybe the bar's so low that even if you've got the beat, it really is about the guidance, right? I mean, if you think about where the stock has been moving, it has been on weaker guidance. We have seen, you look at a name like Snap, really plummet in a big way. Where do you sort of then go from there in terms of your investment thesis? So, if the expectation is that there is some form of recession waiting on the other end.
Yeah, I'm very cautious right now. If you just look at the macro perspective, and I'm going to kind of go, I'm a wild card, so I'm going to kind of just go away from maybe that comment, because I think the one thing that's not being said in this market right now is that the market doesn't believe in the right tail risk of interest rates occurring. And what do I mean by that? That the market does not believe that rates are going to be higher for longer. And what I always tell people is that you have to follow the tape of the market. And if you go back to March 9th when SIVB collapsed, a lot of people forget that the market was flat on the year. And ever since that date, the market is now up 19%. So that date is telling me something. It's telling me that right tail risk of interest rates is off the table. But then, Akiko, look was one of the things you said at the beginning of the show. Look at the 2-year, look at the 10-year. The 2 years back up to 5%. The 10 years back to 4% right now. That's the exact same interest rate that the market was pricing back on those March 9th levels. And yet the valuation expansion has been the only contributor to the S&P 500's performance during that period. So I think my biggest worry on what the Fed is saying right now and what we're seeing with a lot of these earnings, the valuation, is what happens if that right tail interest rate risk is reintroduced to the market right now.